Thanks for joining us at XM.com. You're watching today's market comment by Mario Sajigiriakos. I'm Cristina Marujos. The US dollar came back swinging this week after a series of inflation surprises fueled speculation that the Fed will signal a slower pace of rate cuts when it meets next week. Retail sales disappointed yesterday, but producer prices came in hot. Markets chose to ignore the softening demand outlook and instead focused on the risk of sticky inflation, as consumer prices also exceeded forecasts a few days ago. With inflation running persistently hot, the dollar stormed higher with some help from rising U.S. yields as investors started to position for the Fed meeting next week, where the new dot plot could signal just 2 rate cuts for this year from 3 previously. Shares on Wall Street took a small step back yesterday as indications of cooling consumption from retail sales, coupled with stickier inflationary pressures from producer prices, proved a toxic cocktail for equities. Bitcoin also fell victim to the deterioration in risk appetite, having fallen roughly 8% from the new record high it reached on Thursday, as the resurgence in yields led investors to take profits. Gold did not escape unscathed either, but there were some signs of resilience as its retreat was fairly limited, especially when considering how much real yields have risen this week. In the energy complex, oil prices reached their highest level since November yesterday after the International Energy Agency raised its oil demand forecasts a little. Oil prices also benefited from Ukrainian drone attacks against Russian energy infrastructure this week. If it persists, the rally in oil prices can have repercussions far beyond energy markets, as it could keep inflation burning hot for a while longer, complicating central bank plans to slash interest rates this summer. The resurgence in global bond yields has turned the yen into the sick man of the FX arena once again, despite mounting speculation that the Bank of Japan is about to raise interest rates out of negative territory next week. However, the markets speculate that even if the Bank of Japan pulls the rate hike trigger, it will probably be a one-and-done move. Hence, the rate differentials that have devastated the yen would not narrow significantly, keeping the yen as the world's primary funding currency in carry trades. Looking ahead, the coming week will be extremely busy for traders, with 5 major central bank meetings and a ton of data releases on the agenda. This was today's market comment here at XM.com. Have a great weekend.